Welcome back to the channel of truth, trust, and transparency. On today's episode, I'm going to run you through exactly what happens when you've claimed depreciation on an investment property and then you come to sell. Before I begin this particular episode, there's a few things I want to let you know. One is I am not an accountant. Two, this is not tax or financial advice. You will need to check both with your accountant and your quantity surveyor on your depreciation as well as your cost base and those sorts of things if you are going to sell. So make sure you get the advice and you get your accountant to run the numbers before you go out and sell. This video is for educational purposes only. Secondly, YouTube tells me that about 72% of people that watch my videos aren't yet subscribed. I would really appreciate it. I'm doing a big push to try to hit 500 subscribers. So if you can come along on that journey with me, hit subscribe. I'm posting an educational video on property every single day until the end of the year. So I'm gonna see if I can complete that. If you're hitting subscribe and supporting me, feel free to ask me any question that you have property related and I'll do a video on it. This video is dedicated as well to another one of you guys, another subscriber that had a question. Can you do a video on depreciation when you sell? Of course I can. Of course I can. Let me run you through the assumptions that I've made and I'm going to run you through the scenario of how it works. Now, for this particular video, the assumption that we're making is that the property purchase you've made is an investment property for $500,000 in 2020, right? You have purchasing costs of $40,000. That's things like LMI, stamp duty, legals, conveyancer, all those kinds of things. Now, you've held that property for 5 years and it has increased to $1 million. You've got selling costs of approximately $30,000. Now, what's that? That's your 2% agent fee, legals, and all those kinds of things. And for the scenario where we are claiming depreciation, I'm saying that you've claimed $50,000 of depreciation, which is about $10,000 per year. So it's nothing out of the ordinary. They're the assumptions. And the other assumptions that we're going to make as well is that during the years of holding those properties, we're going to be making our claims on any costs incurred throughout the running of it. So that means at the end of the financial year, we would then give our accountant all the costs and would make that claim there. Therefore, there is no more outstanding items that we're going to add to our cost base, apart from purchase price, obviously, and buying and selling costs. So let's look at what happens when we sell a property when we haven't claimed any depreciation. We've done it normally. The cost base is made up of the purchasing and selling costs, which in this case is $40,000 and $30,000, meaning our total cost base is $570,000. Our gain then is what we've sold it for. What we've sold it for minus the cost base, meaning we've made a gain in 5 years of $430,000. Now remember, the difference between 2020 and 2025 is 5 years. Because they've held the property longer than 12 months in Australia, we get what's called the CGT capital gains exemption. Essentially, it means that if you hold the property longer than 12 months, you are able to keep 50% of your capital gain tax-free, and then you'll pay tax on the other 50%. So 5 years, more than enough time. The property's left to bake, marinate, and grow in value. So it means of that capital gain, $430,000, we keep 50% tax-free, meaning $215,000 is yours to keep and you don't need to pay any tax on it. Now, on the other 50% of $430,000, which is the other $215,000, you need to pay tax on. Now, the other assumption that I'm making here is that this additional $215,000 is going to push you into the top tax bracket. So we calculate how much tax is on $215,000 at a 45% tax rate. It's about $96,750, meaning if we pay $96,750 in tax, we will then have a leftover amount of $118,215, meaning we profit that amount after we've paid tax and the 50% that we got tax-free. Meaning if we didn't claim any depreciation, we would we would be getting back $333,250 on a property that has doubled in value from $500 to $1 million. So not too bad. Now, let's look at what happens if you were going to claim depreciation throughout the life of that property. Again, you've claimed 10 grand a year for the 5 years that you've owned the property. So the same thing occurs in terms of what our cost base are. Here's the thing, and the $50,000 that we've claimed, you'll either hear it added into, two different parts, but at the end of the day, we get to the same part. So I'm going to show you what happens. So the $50,000, it is either minus from the cost base, which means the cost base goes down to 520, and I've made that $1 million gain, meaning I've got to 480. Other people are going to tell you that that's actually a gain that you've made from the property. So it's added to your gain of $1 million. So you now have a gain of $1,050,000, and from that we minus the cost base. Now I've heard multiple people tell different ways. I'm not too concerned if you take it off the cost base or you add it onto the gain, because at the end of the day, if you do either way, you get down to 480K. Now, let's run it through the same scenario. 50% of that is tax-free, which means $240,000. Then we need to pay tax on the other 50%, which means we pay $108,000 in tax, and we're left with $132,000 in return. Meaning our profit is going to be $132,240. Total is $372,000, meaning you are better off having claimed that depreciation than not. Now, here's the funny part. People always think that because you've claimed all that money in depreciation, you need to pay all of it back, but you don't. Why? Because 50% of it you keep tax-free, and then you only have to pay your marginal tax rate on 50% of it. So it's almost halving it, then halving it again in terms of the money you have to pay back. Why? The difference between each scenario is $38,750. So you're $38,750 better off if you were to claim depreciation compared to if you weren't. And you're paying a fraction of that amount back. Because remember, we claimed $50,000, I'm $38,000 better off. $11,250 I've paid back of that amount, of that depreciation amount back in tax. So if you are going to claim depreciation, that is how it's calculated. Just keep that into consideration. What I would do is I would speak to my accountant. Your accountant's going to ask for everything that makes up your cost base. Most solicitors or conveyancers will give you that breakdown purchasing letter and selling letter that has all those costs in there. He will be able to calculate and run the numbers on it for you. But as you can see, even making that depreciation claim, you're still better off compared to if you weren't. But you don't have to pay back 100% of that amount. Here, it's only a fractional margin compared to if you weren't and to go without it. Now, the reason why we claim the depreciation, again, in my opinion, I'd never purchase a property just purely on depreciation. It helps for cash flow, because this property here, let's run a few numbers just off the top of my head here. Now, this property here, $500,000. Now, 450K worth of debt at a 6.2% interest rate, I would have about 27,900 in repayments. As you've been watching my other videos, you know that there's about $10,000 worth of expenses, property management, reletting fees, all those kinds of things. So that property would cost me, let's just say $37,900. Now, it's safe to assume on a $500,000 purchase, renting at a 5% rental yield, I'm going to receive in rent $25,000 per year. So to operate that property in terms of cash flow, if I'm only getting in $25,000 in rent and $37,900 in expenses, it means I would be negative $12,900. Just quick maths. 25 plus 12 is 37,900. Yeah, 37,900. Correct. However, this is why you claim the depreciation, because down here, remember I said I was claiming $10,000 a year in depreciation. So imagine at tax time, I come back and claim that $10,000 in depreciation back in my pocket. It means the property has only cost me $2,900 for the entire year to hold. So that's why we claim the depreciation up front, is to help with this cash flow here, but it wouldn't be the reason that I buy the property. I buy the property because of the fundamentals, the data, it suits my portfolio, it suits my budget, it works there. If I can claim depreciation. It's a sprinkle on top, and that amount will obviously change and differ depending on the property, the age, the works, all those kinds of things. But that is why you'd claim depreciation. And then that, my friends, is what happens when you sell. Any questions or thoughts from this video, let me know in the comments. Happy to do another round. But as I said at the start, I'm not an accountant and this is not financial advice. This is just an educational video to show you in principle how it works. Please get financial advice from your accountant to run the numbers before you're going to sell, as well as your quantity surveyor that does your depreciation schedules. As always, I'll see you tomorrow, guys.